The stock market looks unstoppable. Wars, pandemics, recessions, inflation, political chaos. And yet, zoom out far enough and the line always seems to go up. That single chart has convinced millions of people that stocks are safe, that time guarantees profits, and that long-term investing is almost risk-free. But what if that chart is lying to you? Not because the data is fake, but because of what it hides. Today, we are exposing the darkest truth behind why stock markets appear to always rise and why misunderstanding this could cost you and many more European investors a lot of money. By the end of this video, you will understand the survivor bias built into stock market indices, why famous benchmarks like the S&P 500 are engineered to rise over time, and why that does not mean stocks can't crash and that your portfolio is protected. More importantly, you will learn what this actually means for you, how you should invest today, especially if you are in Europe, buying global ETFs and trusting long-term charts. I am Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Let's start with a simple question. If companies fail all the time, why doesn't the stock market reflect that? Think about household names that once dominated entire industries. Kodak, Nokia, Lehman Brothers, Wirecard. Each one collapsed. Investors were wiped out. Jobs vanished. And yet, when you look at long-term index charts, it's as if they never existed. That's not an accident. That's the design. Here's where it gets uncomfortable. Stock market indices are not museums. They don't preserve history. Probably they could, but they don't. They are living, constantly edited lists. When a company performs badly for long enough, it doesn't just fall in price, it gets removed from the index. Quietly replaced by a stronger, more fashionable, more profitable company. The index survives by killing off its weakest members. That's survivor bias in its purest form. Take the S&P 500. It claims to represent 500 of America's largest companies. But it's not the same 500 over time. In fact, most of the companies that were in the index decades ago were gone. We don't know about them anymore. Bankrupt, acquired, irrelevant. The index doesn't show you the graveyard. It only shows you the winners that made it through. Imagine a brutal reality show where hundreds of contestants enter, but every year the weakest ones are eliminated and erased from footage. Sounds astonishingly familiar to Squid Games, isn't it? At the end, you look back and say, look how successful everyone was. That's essentially what an index chart is doing. It shows you the survivors, not the casualties. Now, here's the catch. This doesn't mean the stock market is a scam. It means it's adaptive. Capital flows away from failure and towards productivity. Over time, economies innovate. New companies replace old ones. Technology improves. Efficiency increases. That's why indices tend to rise over very long periods. But that long period can include decades of pain. Zoom into history and the illusion cracks a little bit. After 1929 crash, US stocks took over 20 years to fully recover. In Japan, just to give you another example, the Nikkei peaked at 1989 and hasn't sustainably reclaimed those highs for about 30 years, up until last year. Survivorship bias didn't save those investors. Time alone didn't save them either. This is where beginner investors get trapped. They see a smooth upward line and assume their personal experience will match it. But indices don't fear. You do. Indices don't retire, panic sell, or need liquidity at the worst possible moment. You might. And for European investors, there's another layer. Most of you aren't even investing directly in US indices. You are buying global ETF, world ETFs, all world trackers. These are even more aggressive in their survivor bias. They constantly rebalance towards countries and companies that are already winning. When a market stagnates, its weight shrinks. When it collapses, it eventually disappears. That sounds comforting until you realize what it means. The rising chart doesn't guarantee your returns. It guarantees that failure is hidden. If Europe underperforms compared to the US for 20 years, your allocation quietly shifts away from Europe. If a whole region stagnates, it slowly becomes irrelevant in the index. The chart still goes up, but your economic reality might not. Here's the uncomfortable truth most influencers avoid. Long-term charts don't promise smooth journeys. They promise that capitalism rewards survivors. That's it. And the cost of survivor is volatility crashes and long periods where returns feel disappointing or even pointless. So what should you actually do with this knowledge? First, stop using the market always goes up as an emotional comfort. It's a statistical outcome, not a personal guarantee. Second, diversify properly. Not just across countries, but across time horizons, income needs, and risk tolerance. Third, understand that ETF reduce company-specific risk, not market risk. And finally, accept this. Investing is not about eliminating pain. It's about being compensated for enduring it. The reason long-term investors earn returns is because most people can't psychologically survive the journey. The index can. You have to decide whether you can too. If you want to understand how to invest with clear eyes instead of comforting myths, subscribe to the channel. Don't forget to hit the like button to help the YouTube algorithm. See you next time.